Alright, here we go with the stocks to buy for May. Now, I gotta admit, this one was a relatively decently difficult list to make. We talk about how much the market's rebounded in the month of April. It's kind of difficult to make a list right now because you never know. There's not that many companies that you might find to be very good deals. So I have 4 here for you today that I think are pretty good deals that I think will be very good given the current economic environment. So first off, as you see listed here, is going to be Realty Income Corporation, or O. This company is also known as the monthly dividend company. So why in particular I kind of like this is because it's one that's been hit pretty hard relative to all real estate investment trusts really have. From their February highs, the stock is still down around 37%, and that's following a very good month of April for everyone else, really. The market went up a solid, 30%, around there, so pretty massive, all things considered. What does Realty Income have to do? So this is a real estate investment trust, in case you didn't know, and that is why it's been hit so hard. So they make a lot of their money really based off of leasing. They lease to tenants, and those tenants pay them money to stay in their properties. So the real main benefit here for Realty Income Corp, obviously the monthly dividend. That's what they're known for. They've raised the dividend 90 consecutive quarters. They've paid dividends consecutively for 597 months, and are averaging a annual total return of 14.6% since 1994, compounding, and an annualized dividend growth of 4.5% since 1994 as well. Pretty freaking massive. That's what I can tell you. They also have a very diversified portfolio. Their portfolio is very diversified when it comes to what they have. 6,400 properties on a long-term net lease, 301 commercial tenants, 301 different tenants, 49 states involved, as well as Puerto Rico and the United Kingdom. We also have 50 retail and under other industries. So if we look at their portfolio, which I think is a big thing to look at, let's look at their top 20 tenants and tell me what of these is going to have an issue in this current time. So their top tenant right now is Walgreens. 6.1% of the revenue is from Walgreens. That is not a concern at all for this company, right? Companies like Walgreens are operating and have been operating this entire time. There's no issue as far as that's concerned. You'll have no one defaulting on any of these leases. We also see 7-Eleven, also a company that's been open the entire time. Dollar General, another company, that's right, it's been open the entire time. FedEx, Dollar Tree, been open the entire time. One that definitely could get hit here, you see, is LA Fitness, one that's been definitely down for quite a bit. Now, a couple that I don't like, you will see, are AMC and Regal Cinemas, and I guarantee you these companies will be replaced with other ones in the portfolio because of the fact that, well, I have a good feeling movie theaters really won't exist that frequently when we get out of this. I have a bad feeling that a lot of these movie companies are going to be hit hard. But then we have Walmart, not going anywhere. Sainsbury's, kind of like the Walmart in United Kingdom, not going anywhere. Lifetime Fitness, again, they're coming back up. Circle K, CVS, BJ's Wholesale. So Kroger, I mean, these are companies, and Home Depot as well, these are companies that frankly aren't going anywhere. The only ones you might find concern are these movie theater companies. I think there's a good chance that these probably cease to exist, and I think that could hurt their revenue, no doubt. And I think they'll pick up leases with other companies because of that. But one thing you really need to notice about this is their occupancy is 98.6%. It's pretty crazy how many... They choose good companies. They choose good companies to lease out to. These companies have the money to survive, and they will pay regardless of what's going on. They'll be paying to keep their businesses open. Even a company like LA Fitness, they will be staying open. Even if they're not allowing people in, they're going to be paying the lease for their properties. So if we look at the dividend of this company, massive stuff. Massive stuff. We look at the dividend history, 26 consecutive years of dividend growth, as we saw since 1994. You see the dividend growth chart here. It's just fantastic. Just a beautiful one. Dividend history, just a beautiful chart. You see raising dividends. Very good stuff. So this company's got a lot going on for it, and I really like what they're doing. So that's why I think it's a good buy at these values. At this valuation, I mean, it's relatively fair. This is a stock that was $80 if we're going back 2 months. If you look from a revenue perspective, that's right. This company is continuously growing revenue as well. So it's a growing company. They're doing a great job. Net income continues to rise. This company is doing everything right, in my opinion. So that's why I consider buying O here. Next, a company I think is slightly unfairly treated right now, and it would be Target Corporation. Why do I say unfairly treated? If we look year to date on this company, this thing's down 14%. I mean, this is matching the market, but this is a company that actually is benefiting from all of this, right? There's a lot more demand in these Target stores, and they're seeing a lot of benefit from it. In fact, we're having reports that, frankly, they grew sales online twice as much year over year for the month of May, or for the month of April, I should say. Twice as much. That's incredible. I mean, what more do you have to say? Obviously, online is a bigger part of it, but comp sales are up more than 7% quarter to date across the core merchandise categories. The only thing really hitting any sort of hits are going to be apparel and accessories. Again, that everything else in their store is benefiting from this. Everything is. So overall, their sales are going to be very good, especially if we talk about the digital growth. We talk about what is the future of retail. Digital is massive, and Target being one of the main players in this is just amazing for them. And they're rocking it. They're absolutely rocking it. When we think Target, what do they offer? And it's going to be same-day delivery through Shipped, right? This is the future of retail. We're talking about same-day delivery. They're one of the few that can offer it right now. It's really awesome, and I think when we get through this new wave of technology is taking over because of this. And when we come out of this, it's going to be a whole different world. We're going to talk about technology is going to be a lot bigger part than it already was. It was already growing massively, and this just kind of put it more in the spotlight. So very exciting stuff for Target. They have a lot going on for them. They also pay a mighty dividend. Okay, payout ratio under 50%, 2.5% yield, and 50 consecutive years of growth. I mean, we talk about the growth of this company. Just lovely. Consecutive growth here. 51 years. Can you believe that? I don't even know how you do it. Annualized growth rate over 10 years of 14.6%. 51 years of growth is massive. And that's what I like. I like these companies that continue to build me capital through this. I love it. I love what they're doing right now. And Target's just a fantastic buy, I think. They're a company trading at a PE ratio of 17 right now, which is, I think, completely ridiculous. If we're talking about Walmart trading at a PE ratio of like 30 right now, Target is pretty much the luxury Walmart trading at a PE of 17 and doing just as well, seeing just as much business growth. It's crazy to me. Obviously, more investors are flocking to Walmart, but Target's going to do just fine. They're going to do very well in this situation. We see on the revenue of this company continuous growth since 2005. Just continuous revenue growth. I mean, this is a lot going on for this company. They're just doing a great time. Great time. Company's doing well. The only bad year you really saw was 2016. They had a pretty bad year. Again, they got into a lot more politics than they needed to, and people were boycotting Target. So they've kind of wisened up, and they've just become a good, solid retail business. So they're just smart. I like what they're doing. So that's why Target is a good buy. Thirdly, you have, I had to mention it. Come on now. I just didn't put it first. Facebook company. Facebook. Everyone knows why I like Facebook. We talk about year-to-date on this company. Still in the red. Can you believe it? Facebook is. In the red around 3.5% since their highs in February. Only down around 7% actually. Crazy stuff. It's hard to imagine that this company's down this type of year. This is the type of market that only benefits Facebook, all things considered. They really are just benefiting from all of this that's going on as we go more and more into the digital age. So they actually are seeing an increase in business right now. So the only concern for them, obviously, as we talk about ad rates. Ad rates in the short term are going to be hit. But what isn't going to be hit is user growth. User growth is massive right now. Just absolutely massive. And we talk about every platform for Facebook. So we have Instagram, the fastest growing social media platform right now on the market. We have WhatsApp, also growing massively. Just a continuous, fantastic business right there for them. Very good acquisition. And then we also talk about Oculus. Oculus is the leading VR company right now. And this was a fantastic acquisition by Facebook. They're the leading VR company, and VR is only going to become more prevalent. They're leading in terms of technology, leading in terms of sales. Everything going on for Oculus is amazing. And they're going to be a leader in the future in terms of VR as well. So that's just a massive part of their business in the future. They don't mention it as much as you typically see. Typically, they talk about growth in users, and they've seen a massive growth in users, more than they typically have in the past, because more people have free time. More people are on Facebook now. They're using their web pages and Instagram and stuff like that to keep in contact with people. We also started Facebook Messenger group chats. So this is going to be like Zoom meetings, where you have virtual meetings with people, virtual conferences, video calling. It's going to be massive for them, especially in this time, as honestly more people are going to do video calling than ever once we get out of this even. So video calling is massive right now. This is a company trading at a PE ratio of 28, forward PE of 28 as well. I think it's pretty absurd. Price to expected growth of really just over 1 on this company. Seems incredibly crazy that a company growing this massively is only going to get a PEG ratio of 1, right? This company should be priced a lot higher, and a PE ratio of 28 just doesn't seem right for this company. It's going to be really one of the leaders right now through this, and they only seek to benefit from this, and they're trading at a PE ratio under 30. That's crazy. And when you look at the revenue of this company, it's absolutely insane. Have you seen a revenue chart this beautiful? Green, green, green. It's all green. Not a single bad year since 2010 here. It's all beautiful with this company. Son of a gun. It's all beautiful. What more can you say? I love what they're doing. They're growing revenue rapidly all the time, consistently. Just things are going super well for Facebook right now. That's why I think it's worth a buy even at this valuation. Activision Blizzard is going to be your final one. And I think you can understand why. This is a time in which Activision Blizzard, as long as management doesn't botch it, they have a very good time to benefit here. Now, you can argue, year to date, this company is actually up 10%. And there's good reason why. It's been a stock that's been slightly unfairly maligned over the years. We're talking about since the high points in 2018, the stock's still down 22%. In a time in which 2019, the market went up 30-something percent. Or nearly 30%. So, all things considered, this stock still isn't quite fair valuation, in my opinion. I think it deserves a little bit higher of a price-to-earnings ratio. If we look at the value of this company, price to forward PE of around 26, I think it deserves a little bit higher because how much it benefits from this market condition. Video games have been awful lately. The past 2 years have been a disaster for video games, and that's why you've seen this stock decline. But right now, we're going to see a resurgence as more people are out of work, having more time to play and buy video games. We're talking about what they own as far as Activision. They've got Call of Duty, Skylanders, Sekiro, Spyro the Dragon. From their Activision category, from Blizzard, they've got, obviously, World of Warcraft, which is going to be just massive. As we talk about people getting back into World of Warcraft Classic that they released. We've got Overwatch, continues to be massive, and we talk about esports. This is the face of the esports game right here, Overwatch is. So esports only becomes bigger. They've got Heroes of the Storm, StarCraft, Diablo, and Hearthstone. And from the King brand, which a lot of people don't think about for this company. King brand, obviously known most for their Candy Crush. Candy Crush is one that continues to actually bring in revenue, believe it or not. And now with mobile games being played more than ever, King only seeks to benefit more. So really, Activision Blizzard is going to see a lot of benefit this quarter. Things going to be really good for them over the next, really for the rest of the year. We also see benefit from Major League Gaming, which, that's right, it's going to take a hit in terms of crowd size, but Major League Gaming is just the future. It really is. So I think this is a very future-proof company right now. They're doing well for what they're going to project in the future. Revenue on this company, again, I talked about video game sales being kind of sucky the past 2 years, and they have been. You're going to see a resurgence, though. This company's doing well, and they're going to continue doing well. This is a good time to pick up Activision, in my opinion. I think they will go up in the short and mid to long term as well. So, Activision Blizzard, one I'm picking up. These are the stocks to buy for May. I hope you enjoyed.